But let me also bring on board Sandeep Bagla, who's the CEO of Trust Mutual Fund. Great to have you on the show, Sandeep. We have been witnessing extreme volatility at highs, right? As I was mentioning at the start of the show, in Friday's session itself, we saw the Nifty hit a fresh high and then take a dramatic U-turn and clock its worst drop in almost 2 months, in intraday trade. But would you attribute this volatility to election jitters? Would you say that once that 4th June event is out of the way, that's when we'll see a decisive trend emerging?
See, markets are a little nervous because at higher levels, a lot of follow-up buying might not be really happening. And globally also, if you look at the geopolitical situation, the interest rate policies, the central banks and the US economy, which is the mother market of all economies, there are uncertainties. Geopolitical risks are rising. We have had a dream run for the last 7-8 years. So fair to say that some of the best case scenarios have already been priced in. And globally, we don't know whether good news is good news, bad news is good news. So if the US economy weakens, while there will be expectations that interest rate policy will be a little milder and there will be rate cuts, but one must understand that this is not going to be a start of a big rate cut cycle. There could be minor rate adjustments. There are liquidities at an all-time high. The financial conditions index are very good. Equity markets are doing very well. So there is no reason for the central banks to cut aggressively and overheat the markets. And when the fiscal policy is loose, monetary conditions have to be somewhat tighter than what they should be. So all in all, I think there are too many factors which the market has to figure and negotiate. And hence a little amount of caution in profit booking is not completely out of order.
Right. If you look at, how the Indian markets have fared vis-a-vis their global peers, we have seen some bit of underperformance, right, in our markets. Especially if you talk about China, over the last 8 to 10 sessions, we've seen Chinese market do very well. We already know that foreign investors have been net sellers, right? We haven't seen big buying coming in from, FIIs. But do you think Chinese markets could be one threat when it comes to FII flows?
See, I would not put too much weight to FII flows because the domestic flows more than compensate those flows now. I think if you have to look at a slightly longer perspective, if you leave out the last 8-10 sessions, over a medium-term perspective, India has performed well. And these things tend to normalize over a longer period of time. So I don't see that China market doing well or Japan market doing well is a great threat. See, we are right now going through a phase of very easy liquidity globally. As per what I saw last, the US balance sheet, the US Fed balance sheet was more than $7.5 trillion. And the combined G4 balance sheet is about $21 trillion. All that money is sloshing around the global system. And wherever there is a hint of growth, there is mild optimism. Money will move there and try to, price it to perfection, such that the performance in the near term will look good. So this is a play, I think, on global liquidity, a rising risk appetite, and some amount of, money chasing returns. So there will be phases when money will go to China. There will be phases when money will go to India. Whatever is undervalued, money will tend to flow there. So I don't see that as a major medium-term threat to Indian markets.
And what about the broader end of the markets? We saw some bit of correction after the SEBI diktat, but would you say that much of the froth has already cleared, or would you say that some bit of correction is still due?
First of all, I don't think there was a SEBI diktat. It was just an observation which was quite balanced, and only the negative part the market caught on. I see there is definitely froth in terms of valuation. Stocks have gone up 4-5 times in few months. So one cannot deny that the best case scenarios have already been built in. So we'll have market, I think, will wait for some amount of performance to catch up. And I think there could be some amount of time correction, if not a price correction.
All right. Let's then talk about sectors then. IT, for one, of course, we've seen the numbers from the big tech companies, right? All of them largely missed estimates. And last week, of course, this was the sector that was the biggest underperformer. But do you expect the underperformance to continue? And if yes, would you advise investors to rotate out of the sector now?
See, IT is a large sector. Okay, it's a large employer in India as well. And when I went to some of the management institutions, I realized that IT companies are not really hiring at the same speed at which they were hiring, a year back or 2 years back. So this tells us something that they are not themselves very optimistic about the demand projections. And if the US economy slows, there is no real reason for one to get over bullish on IT sector. So obviously you cannot change the allocations beyond a point, but one needs to be a little less optimistic and buy at dips, I would say, in the IT sector with a long-term perspective.
But is there reason for bullishness when it comes to private banks? Because we've seen some margin surprises from some of the top lenders. Even though Kotak had to go through a spate of bad news, the numbers have been pretty good, and the management has also outlined the kind of profit impact it will see arising out of the RBI action. Would you call this as a big winner of the fourth quarter earnings season, the entire private banking lot, and how should one really go about playing this particular space?
We must understand that the private banks are perhaps the most efficient in terms of marketing financial products. There is tight liquidity in the system, which might compress margins over a period. However, low inflation should help with that. I see some amount of regulatory supervision in terms of the risks that are building up in the system. I feel quite concerned about the build-up in the unsecured loans in the banking system as a whole. And I do see that some amount of restrictions could come to temper the speed at which the loans have been growing. And I think one should be a little cautious in terms of private banks as well. More in terms of what capital restrictions could be coming in the future rather than their efficiency. So I see a good run could continue, but one must keep in mind that the speed at which the retail loans have been growing is concerning, and to regulators as well.
What about the PSU lot? Last time we spoke, you mentioned that PSUs should be looked upon as a marathon and not a sprint. Of course, we have seen quite a bit of a marathon play out when it comes to PSU names. But power stocks, of course, continue to power ahead. But if you look at the defense name, they've kind of slowed down a bit. I'm just talking about the last 1 month performance. So where are you finding value after, last time we spoke, it was 2-3 months ago. Has your view changed, and where are you really seeing value in the PSU basket?
I would say that markets have learned that PSUs, the elephants can dance, and the opportunities aplomb in the markets. So I think PSUs are turning around. I think the perception about PSUs are changing. So I think they are by and large a buy on dips. And depending on the sectoral outlook, I think one should add on every dip.
Last couple of questions, really, Sandeep. Two-wheelers, have had a good April. In fact, in terms of their sales data. From an investment standpoint, would you look at two-wheelers vis-a-vis four-wheelers now? Do you think the runway for growth is higher when it comes to two-wheelers now?
Yeah, I would think so, because monsoons are going to be good. They are predicted to be good. So I think also, I have traveled across the breadth and width of the country when we were marketing our FlexiCab fund. And I see that the conditions on the roads have really improved, and there's a lot of growth in the so-called tier 2, tier 3 cities. I think the two-wheeler segment should be a relatively better bet going forward.
Lastly, of course, we are seeing sector rotation in the market, and there is, a sentiment of risk aversion as well as we battle, geopolitical tensions, and of course, there's this June 4th event that we are waiting for. Which are the pockets that offer safety at current levels? How would you advise investors, or what would you advise investors to do right now if they are looking for sector rotation? Which sectors should they nibble into?
I'm so sorry to say that, but there is no safety in equity markets. I'm so sorry. One has to increase their staying power and invest for the long term. If one really looking for safety, I think fixed income is a great idea. I'm sorry, I've been a fixed income manager for some time in the past, but objectively speaking, I think fixed income provides a very good return at this point of time if one is looking for safety. You have inflation expectations of 4.5%, and you are getting 250, 300 basis points higher than that on fixed income products, which are getting you 7.5 to 8% on the AAA variety. So I think if one is looking for safety, then fixed income is better. If one is looking for growth with a medium-term perspective, then equity remains the king.
All right, that's the view then. Of course, Sandeep, with that, I'm afraid we are running out of time. It was great catching up with you as always. Look forward to having a longer conversation with you sometime soon. Thanks a lot for sharing your thoughts with us.
Bye-bye. Have a great day.